The views expressed in this video are those of the panelists and do not necessarily reflect the views of U.S. Money Reserve.
Welcome to America's Gold Authority podcast. My name is Mike Barnes. We have some good news and some bad news about the economy. The good news, inflation not as high as expected. The bad news, labor markets a lot weaker than we thought. What do those numbers mean for interest rates? What do they mean for gold? We have some experts who are going to tell us the answers. Philip Diehl is here, so is Brad Chastain. And Philip, I want to start with you. As the 35th director of the U.S. Mint and as president of U.S. Money Reserve, is this a glass half empty, glass half full thing with these numbers? What do you like and not like about them?
Well, I think it's, in some respects, it's good news. It's a glass half full. In that I think it confirms the likelihood that the Federal Reserve will be cutting interest rates in their next meeting. The labor markets are so weak. In fact, we got a report early this week showing that out of a total of 160 million jobs, less than a million represents something like 0.6% of adjustment. But what it does mean is that the economy is a lot weaker than what we thought it was earlier in the year, and it just makes it more likely the Federal Reserve will cut rates in order to stimulate the economy. And it may make it more likely that there are additional cuts in the months ahead.
Brad, do you agree? Is it weaker than we thought?
It's weaker than that number has suggested. There's been other numbers for the last couple of years that have suggested similar. There's been a lot of attention brought over the last couple of years to the differences between the payrolls number, the establishment survey is what Philip's referring to there that was adjusted down, and the household survey for going on 2 years has been consistently weaker. And that's a survey that doesn't just look at businesses and their payrolls and surveying them, but it actually includes sort of a broader set of the economy. Might be different in sample size, but it includes farm workers, it includes those that work without pay in the house, and it surveys overall sentiment as well. Just how are people underemployed? Do they have the job they want? Are they looking for something else? Are they working multiple jobs? And a lot of those things. And that has shown weakness now for a couple years, and people have questioned the differences. And this, it kind of brings them a little bit more in line.
Brad, that labor force number of 911,000 people or jobs that are suddenly missing, is that offset at all by the 2.9% consumer price index?
Potentially. The inflation number that went down, surprised to the low side, was specifically the PPI. It was the wholesale prices. So that tends to be a leading indicator compared to the consumer price index that gets a lot more attention out there. That came in today, and it was pretty much as expected at 2.9% year over year. It was really the wholesale prices yesterday that were a surprise to the downside. So to me, it's not that surprising. I think a lot of people were, but if you remember a couple weeks ago when we were talking, we were talking about a high kind of CPI or inflation print. And I had said that, at this point in a business cycle where things have been low for a long time, if you look at purchasing PMIs, purchasing manufacturers indexes for the last couple of years for both services and manufacturing, they measure business activity. And as business activity in manufacturing and service expanding and contracting, and it's been in contraction since COVID for the most part. Only recently have they stopped, and some of them gone a little bit positive. And so what I was saying then is that if you get a recovery, which at this point, historically, you would expect to see an economic recovery, we should see prices go up at that time. Goods prices start picking up because there's more demand for goods. And so, and the fact that it's not higher, to be honest with you, brings back the concern to me that I brought up several weeks ago, that we need to watch it going forward, because if we don't see it continue to pick up, that means potentially demand is a lot weaker than what we would like to see in the economy. We talk about inflation just like it's an overall bad thing. And for your portfolio, it's bad. For what you have in the bank, it's bad. You can buy less. You absolutely have to protect yourself financially from inflation, but from an economic standpoint, what it signals is that demand for goods overall are larger than supply, and eventually pushes prices up, and then eventually manufacturing comes in and pushes supply up to slow that. It's an important signal. And if you don't get inflation during a good economic time, that's actually something to start being concerned about. So for me, it's not that surprising, especially with the labor data that we've seen, that we're not getting the demand piece there. And it coincides with other reports that we get from especially retail in the lower income areas. The Walmarts, McDonald's, Dollar General have consistently been reporting weaker consumers. And so that is something that would indicate not as much inflation pressure. So if the hike that we've seen has come from tariffs alone and not from having a strong economy, that is something to be concerned about going forward, where things lead, because we saw that step up in prices as expected from tariffs. And remember, PPI, the producers is leading. So you saw that tick up. Later on, you saw the CPI that falls to the consumers tick up. Now you've seen PPI come down. If CPI comes back down too, then that could be troubling for the economy as a whole in terms of what it's saying about the economy.
Philip, Brad kind of reinforces the fact that we have to keep our eyes on so many numbers, but especially the interest rates. 0.25% is the rumor of what is going to be affected when the Fed meets later next week. How is that going to affect the economy?
The discussion is going to really shift and has begun to shift to two other possibilities. One, I think the more remote possibility is that the Fed will decide not to cut interest rates by 25 basis points in their next meeting, but to do it by 50 basis points, because these numbers look like the economy is a lot weaker than we thought. Also, that inflation may not be so much of a threat as what we were concerned because of these low PPI rates that Brad was talking about. So there's going to be, and there has been some discussion of a 50-point rate. I'd be very surprised if the Federal Reserve decided to make that large of a cut. But I do think we can look forward to the possibility of a series of rate cuts over the next several months, perhaps 2, maybe even 3 over the course of this year, and then more into next year. So I think short-term interest rates are headed down if the Federal Reserve is cautious about what that pace is and are able to manage inflation expectations to keep them low. Then we could see a series of short-term rate cuts that would lead to some reduction in longer-term rates, which is really what matters to most of us who run businesses, who are looking to refinance mortgages or to buy a new home, to buy an automobile. Those are the 10-year rates are the ones that really affect us in the most immediate way. I think the Fed still has really a very narrow margin to guide monetary policy through. We'll see in the months ahead, and the Federal Reserve is going to be watching very closely those labor market numbers, also the inflation numbers. I don't think anyone is really anticipating that we're through the risk of higher inflation. 2.9% inflation rate for the CPI is nothing to brag about. It's actually a step upward and away from the Federal Reserve's target of 2%. I'm seeing some speculation that the Federal Reserve may be loosening its goal of 2% to something like 2.5 or even 3%. I think that speculation, especially if it were well-founded, would be bad news for the economy, because already inflation expectations in the public are very high. And it's clear from the surveys that Americans feel like inflation continues to ravage the economy or ravage their budgets. And once those expectations get elevated, then they're really hard to knock down.
Brad, I want to go back to the interest rates. And if it goes down 25 basis points, how will that affect gold?
So first of all of the economic concepts are really confusing, complex, intertwined. Almost every time we talk about one data point, there's offsetting factors that push in both directions on different things. And so oftentimes people will get confused because we'll talk about one thing and the directional push, but it doesn't mean that something else is going to happen because there's other factors we may not be talking about that go more in the other direction. So, but in the simplest term, rates going down is typically beneficial of gold. One of the simplest to understand is just opportunity cost. Holding gold versus having it in a savings account earning interest. When you're earning higher interest rates, there's more incentive to take the risk of putting your money in the banking system to get that return, less incentive when rates are lower. It's the simplest way to think about that. And I agree with Philip, 25 basis points looks like where it's going. Markets right now have priced in 90% chance there's a 25% cut, a little less than 90%, and only about 11% or so of a 50 basis point cut there. And one thing that, again, just like these offsetting economic factors, it's important for people to understand is that, as Philip mentioned, that cutting the rates is helpful for a variety of reasons, lowering borrowing costs, being more stimulative for the economy, lowering the interest expense for businesses as well as the government. But lowering rates is also, like inflation, a sign of not strong economy. You don't cut rates when things are going well. So just simply the fact that they're cutting rates shows the negative and weak side, even though it's kind of that offsetting push. So that's where it gets tricky, is oftentimes people will overweight one factor versus another and then just directionally say this is where things are headed, when they sometimes will miscalculate the weighting of the variety of things. And I agree with what Philip said earlier, that 25 basis points isn't going to be much of a surprise or a surprise at all for markets. They're already priced for that. You asked for a couple of weeks ago about gold, and were we surprised that gold had gone up with ahead of rate cuts? And absolutely not. That's what markets do. They're forward looking at what's likely to happen and pricing things accordingly. And that's why it's so important for people to understand that waiting until they find out what happens, oftentimes people say, I'm going to wait and see, is completely the wrong approach, because at that point it's too late. Markets have already priced in those probabilities. It's only the shocks in one way or another that then make all of the volatility. It doesn't mean we won't see some volatility. When the rates are announced, even as expected, you see some volatility, even just because some people are always hedging and placing sort of insurance bets that it doesn't match, even though they think it's going one way, they just want to protect themselves another way. Those things get unwound at those times. And so you still see flows in the market drive some volatility, but nothing to the extent of if it's an actual surprise. And then the other thing is, there's other things right now in the next few weeks that can increase that volatility. For one, the Treasury has been rebuilding their checking account, the TGA at the Fed. That's taking money out of money markets right now, and that's less liquidity for markets. It doesn't mean things would go down as a result of it, but if you think about the foundation of a building, and there's a lot of different pillars, there are things that are making some of those pillars weaker. And taking money out of markets, rebuilding TGA is one of those. We have quarterly tax receipts coming up in September. Historically, it can be kind of a volatile time because of that. That's more money coming out of the markets, again, going into the Treasury's account. There's quarterly options expirations. So that's usually a big time for pivots, when lots of people are making bets in the market that get unwound when those options are expiring later this much. And that, regardless of anything else, can drive flows through the market and create volatility. So none of those tell you where things are headed, but what they do mean is that if there's anything else, a surprise in interest rates, geopolitical conflict, anything else that does move markets a fair amount, those sort of cracks in the pillar that are none of those are necessarily supportive of the market, can make it a lot bigger of a deal than it otherwise would have been.
Yeah, I want to follow up on 2 points that Brad has made here several times. One is that one data point is a very thin reed to lean upon in making decisions about what's happening in the market and what you should do with a portfolio. Not only because there are a lot of other data points that are in the mix that are pushing prices one way or another way. Also, one data point is not a very stable point of view on what's happening in the marketplace. Those numbers are inevitably adjusted. They are preliminary numbers. And so people who are watching the marketplace are really wise to look at several months of data, several data points, and to see what the trends are, and work accordingly off of those trends and a wider look at related data points. Now, and our entire conversation this morning is indicative of another issue that Brad alluded to, and that is we can so hyper-focus on what's happening in credit markets, for example, or in the stock market, or in gold price trends, and all of those things are worthy of close attention. But what often happens with that is we lose sight of other forces in the marketplace that are likely to have a big impact, might have a huge impact that overwhelms any impact of what the Federal Reserve might decide to do in its next meeting or its next several meetings. And one of those unseen forces that is working right now is the possibility of conflict between NATO and Russia. The decision by Russia to send in some 15 to 20 probes in order to determine whether or not NATO reacts strongly to its incursion into Poland is an issue of real concern. It indicates a willingness of the Russians to significantly increase its escalation in its gray zone war with the West. Right now, we're going through a process of interpreting exactly what the Russians are attempting to do, but none of it is good. And the fact that the Poles have convened a meeting of NATO under what's called Article 4, which is a consultation process in preparation for the possibility of invoking Article 5. And Article 5 is really the last step toward NATO and Russia entering some kind of conflict expectation and the reality of potential conflict. So this is entirely the possibility of a prelude to conflict of some kind between NATO and Russia. I don't think the Russians are attempting to enter into some kind of a conflict with the West. I think what they're attempting to do is encourage the West to not invest further into the Ukraine war. I think that might work to a degree with the U.S., but I think it will backfire with the Europeans, and it will further increase their resolve to help the Ukrainians. But we can't take our eyes off the picture on these other forces that have driven gold prices. We have to remember the geopolitical conflict is what started this rally almost 2 years ago when Hamas attacked Israel. And the degree of geopolitical conflict that has occurred over the last 2 years has been very intense. It's really spread and ratcheted up those tensions.
Great reminder that there are so many factors that we have to keep our eyes on as we go forward with the economy, with the price of gold, and all of these things that are happening in the world today. One final question, though, that I want to ask. Philip brought up earlier the fact that if the interest rates are dropped next week, and they could drop even more later in the year, there could be 2, if not 3 times that the Fed drops the interest rates. Brad, you mentioned earlier that that's a sign of a bad economy. So if we know or we think that it's going to happen 2, maybe 3 times in the future, what does that say, and what do we need to be prepared for?
Need to be prepared for, honestly, anything. There's so many different opposing forces. Nobody knows what the outcome of any one of these forces is, because many of them are in opposition to one another and will overcome something. So something will lead to something that should move things in one direction, but it also impacts something else in a different way that's overpowers it in another direction. And that's why, headlines in the media and folks are always so incorrect in predictions, is because they'll focus on one thing and that might be right, but they're missing other things. And it's too complex of a world to fully analyze, assign probabilities to every single one. The important thing is to know that there's always going to be surprises. There are always going to be things that nobody anticipates that come up. Some of the most significant ones are the ones that nobody anticipates. And if you wait to see what happens, it's too late. You need to have a portfolio that is designed to weather the various possibilities. Because if you don't have it ahead of time, there's nothing you can do about it at that point.
Yeah, this is something that Brad and I have been beginning to harp on a little bit, and that is the conventional wisdom is that when you expect the economy to strengthen, then you want to have your money in stocks. You take a little more risk and you get a little more return. And then when the economy is weak, then you want to go to a safe haven like gold, because gold will hold its value while other asset classes like stock decline in value. Well, the reality is that gold has been outperforming stocks, even in good times. Last year, gold outperformed stocks when stocks increased in value by 24%. Gold had an outstanding year. Gold has outperformed stocks this year by an enormous margin, but by more than 3 to 1. And of course, it's been a little bit rocky at times for the stock market this year, but time and time again, stocks have set new records this year. And yet, if you had made a decision to invest in gold because you wanted to hedge your bets on the economy, then that would have been smart. And if you decided to take greater risk and invest in stocks this year, well, you would have lost ground compared to what you would have made if you had been invested in gold. So we're in an unusual circumstance, and I think we will continue to be in this circumstance for the foreseeable future, in which the smart move, whether you are optimistic or pessimistic about where the economy is headed, the smart move is to buy gold, just as it has been for the last 2 years, and the way it's been for the last 25 years, during which time gold has outperformed stocks. So I think we really need to recalculate our thinking about the role of gold in a portfolio. It is not simply a hedge against bad times, against inflation, against recession, against the possibility of war and geopolitical conflict. It's, in these days, a winner under both scenarios.
And there's an important reason about that, why that is, that we've talked about over the last few weeks as well, is because that even during times that are good, what does that mean? It means there's more borrowing, there's more credit creation. This is a debt-based monetary system. That means there is more money that flowing around the system. That's currency debasement, and gold is the ultimate hedge against the debasement of currency as more currency is created. And more currency gets created in strong economies when people are borrowing and banks are lending more during that. That's when you see money supply go up, and gold is quite correlated to that.
More proof that gold is more than just a safe haven. Philip Diehl, thank you so much for joining us today.
Thank you, Mike.
And Brad Chastain, I think you have proven the media needs a director of education like you. Thank you for being here.
Thanks, Mike.
That's all the time we have for today's episode. On behalf of all of us here in the U.S. Money Reserve Studios, thank you for tuning in. If you have any questions or you want to learn more about today's episode, you can call the number in our episode description and speak with one of the friendly account executives. They will be more than happy to answer any questions you may have about precious metals and the strategic role they can play in achieving a secure and comfortable financial future. I'm Mike Barnes. We will see you next time on America's Gold Authority podcast.
The markets for coins are unregulated. Prices can rise or fall and carry some risks. The company is not affiliated with the U.S. government or the U.S. Mint. Past performance of the coin or the market cannot predict future performance. All calls recorded for quality assurance. Offer void where prohibited.